In December 2015, the Federal Reserve raised interest rates by 1/4 point. Going forward into 2016, we've seen considerable market volatility, and it is expected that the Federal Reserve will raise interest rates again another 1/4 point. Joining me now to discuss this and other issues is Tracey Manzi, VP of Investments with Cammack Retirement Group. Tracey, thanks for joining us on the show today.
Thanks for having me, Jeff.
I know that you like to cover macro issues, volatility. We're since, I guess, July, August, maybe even earlier, we've faced a lot of market volatility. Scarce participants, a lot of phone calls to the vendor and the plan sponsor. I know that you have been tracking this on a regular basis. Any thoughts as we enter and begin 2016, China, emerging market, interest rate rise? Any thoughts about that, how that volatility looks? Not asking you to project into the future, to look at your crystal ball, but just some general thoughts, how to manage that. And I know it's not what you do on a day-to-day basis in terms of guiding employers on how to communicate, but just some general thoughts around the market environment as it stands today.
Certainly. Well, I certainly look at volatility every day and think about the markets and positioning, even though I'm not necessarily having those end conversations with the plan participants. I would say, given the environment that we're in today, where the macro environment is less stable, you've got China slowing, you've got the Fed embarking on kind of a divergent policy where their rates are actually now starting to rise, where the rest of the world is still lowering rates. I think it's likely that we'll see more volatility in the future. I think that'll be one of the themes for 2016 if I had to wear my investment hat during that time. For plan participants, what I would say is, as always, you don't want to pay attention to the noise. You want to think through the long term. You want to have a diversified approach to your asset allocation so that you're not moving your portfolio around at the wrong time, selling at the wrong time, and then buying at the conversely at the wrong time. You really want to take that slow and steady approach and plan your asset allocation. However, I think with the market volatility that we're seeing, the fact that Fed policy is now moving in a different direction, it gives you time to reassess your portfolio, to look at where all of your allocations are. You may consider dialing back risk a little bit, knowing that if you feel like you've had appreciation in some of these asset classes that have done really well, whether it's equities, high yield bonds, maybe you want to reallocate to something a little bit safer that's going to help you ride out that volatility. And then conversely, when things get cheap enough or valuations change enough where you want to take some risk on, then you can do that. But certainly we're moving into a risk-off type of marketplace where volatility will be continuing for, I think, the near term.
Tracey Manzi, very insightful comments, and looking forward to having you back on the show a little bit later on in the year. Thanks for joining us.
Thank you.